Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with The Street, and together we bring you the Morning Call Express. In fact, our final morning call of 2012. So this is quite a year it has been.
Yes.
And it's not over yet. We have 3 trading days, including today. Going into the end of the year, we have Obama coming back in town, so we might get some more fiscal cliff language in there. But there's really a lot to look at, even though we're in thin, choppy trading.
Yeah, and we've been down 3 days since Friday when Plan B was thrown out the window. And just like this year, with this being the last morning call, there are times to have risk on and there are times to have risk off. We've had so many different intermediate trends to trade, times when the condition of the market was more conducive for having a big portfolio approach versus a small portfolio approach. So now as we head into the last few days of the year with some of this weakness and a lot of these unknowns, I think the traders are just trying to keep some risk off, stay with the existing positions that are working, trading around them, using a hedge, and then I do think that we'll get a lot more action, once the new year kicks off in 2013.
So going into trade today, what levels are we taking a look at? Because we still have some economic data coming out today, including jobless claims, which will certainly move the needle. Right,
and then also housing starts. So I would say right now, if you look at the chart of the S&P, if you go right here, you will see that we've been in a nice trend ever since the November lows, November 16th low. You had your big gap and go, and from there we've been following this uptrend, so to speak, with a nice methodical move. And then yesterday we came pretty close to touching it. We're very close to the 50-day moving average. So I would say at this point, we're a bit bent, but the market is far from broken. I think a lot of guys are going to be using this 14-13 as their line in the sand. If we start breaking below that, you could see us, bring out some more weakness. But overall, guys are still staying with positions. We had some resistance into, this prior congestion. So I don't think this is the end of the world. And we're going to see some bigger volumes come back in come the new year.
Moving along to the sector spotlight, we're going to focus on retail, which really was pretty strong for 2012. The strength of the consumer was relatively surprising. I think this particular group, it was sort of buy the rumor, sell the news, because we've seen just about every name, whether it's brick and mortar or an online retailer like an Amazon, come back in. And you can certainly see that in the ETFs, whether it's the XRT, the RTH.
Yeah, and right now, you can see by the chart patterns where you have to have some high-level stops or some lower-level stops. You look at the XRT real quickly, you will see that, you look at this chart, and it really wasn't telling you that there was going to be a lot of weakness. You did have some choppiness in here, but overall, yesterday, a wide-range bar. It's below all these moving averages curling over, so that's a little bit of a telltale. If you look at just a TJ Maxx, brick and mortar, this is when this trend broke over here, and then recently, it tried to bounce back up and then failed right here. It's actually at the 200-day, which, a lot of the indices aren't even near the 200-day, so that's showing some excessive weakness. Take a quick look at cores just real quick. I just want everyone to, note that we had a really big move in this stock since the IPO over here, and it's trying to hold up. I would watch this area. I would watch this, 49, very, very closely. And then even look at something like Amazon. It's been a great mover. We talk about this all the time. It broke from this descending channel to the upside. And then if you ever want to protect gains, you have to honor stops. And this high-level stop right here was very important. This 255, it broke it, closed in the dead lows yesterday. So at this point, I'd be a little weary here, and I'd be watching this 247, 248 as an intermediate trend.
Well, preliminary sales data, too, suggests that 2012 wasn't quite as strong as analysts may have expected. Again, those are a lot of arbitrary numbers because they're certainly projections. It's really hard to tell just based on foot traffic alone. Moving along to Apple, which is one of the biggest consumer and technology names, let's wrap it up with our favorite name to trade.
Yes, on every time frame, everyone's very concerned about this. And I think there are a few decent things going on here where Apple has been so weak and out of play, but the market's kind of putting it on the side. But the question is, if Apple does break below, 501, 505 and starts to get a 4 handle, how will the market psychologically handle it? You look real quickly here at the chart, you will see on a micro version, here is that upper head and shoulders pattern that triggered to the downside right when it broke below the 660, went below all the moving averages, and then fast forward, big move all the way down to that first time it hit that 505 area. From here, you had a tradable move back up to this trend line where it failed and came down again, and now you have this little tight pattern. Say short term, I would say there's a small hope that it could break this trend line here, maybe get above 525 and get some kind of rebound into the new year up until about 550. But if that doesn't start to materialize, this don't pass line right here around 501 to 505, we close below that, and then all of a sudden pressure is going to come in, and then the elephant in the room for next year really is this head and shoulders top pattern that a lot of guys are talking about, where you have the left shoulder, the huge head. You know, we just put in the right shoulder, and again, a break below this 501. First stop is 486, and then really you don't have any big support until about 440. So at this point, I would take a very short-term approach with Apple, or just have a little risk off.
Well, there certainly is a lot to look forward to in Q1 of 2013 for sure. In addition to our major themes that we've been talking about, a lot of M&A activity as we see some cash put back to work, and of course CapEx. So we'll look at sectors like the industrials and technology. So it's certainly not going to be quiet at the end of the year, and we certainly have a lot to look forward to going into 2013.
And I would just take it incremental. A lot of people are trying to make guesses on which way we go. I know last year was a little easier. We were wedged, and I said above 1270, first quarter inflows, we can go. This time coming into the first quarter, there's a lot more headline news, a lot of things going on. So I would say don't go in with guns blazing. Just go in with positions you like, continue to manage them, and then just watch to see if the market confirms if we head higher into the first few weeks or months, or if we do a head fake to the downside and then continue. But ultimately, I do think that we're going to have a decent year in the markets next year, but the first few weeks could be a little shaky.
Okay, well, from our family at the street in T3, have a very happy and healthy New Year.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.